Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, here we are. Good to be with you.
And happy snow day. Vancouver apparently about to get pasted.
Oh,
today.
It's going by out here sideways, the wind straight from the east, and it's supposed to do, in various places, up to 20 centimeters, which in real measures is getting close to a foot. So
yeah, and
I more readily understand feet and inches and stuff like that.
Oh, me too. And I was going to say, too, for the rest of Canada, we really do have palm trees in Vancouver on English Bay.
Yeah.
And they hold up the snow just fine because it only lasts for a day or two.
Well, I really don't like it when they plant these palm trees, because palm trees, if you get them from the Sahara, they're used to frost overnight in their winter times and temperature dropping down, big changes. So, but I don't know whether you could grow them in other parts of Canada, but I just don't like them. So, give me a chance to do a little rant here, Jim. So
anyway, so it's just a little reminder that Vancouver is part of Canada. We do get snow occasionally.
Yeah.
Bob, the equity markets, now, of course, they had that, now I guess people are going to call it a burp at the start of February. And now they seem to be pretty healthy, although the Canadian stock market lagging quite a ways now, I think, behind the U.S. markets. Yeah,
well, the problem is that the senior index in Toronto, I don't know what they call it these days, has the gold stocks in it. And typically when you're in a bull market for regular industrials, the gold stocks really don't perform. So it screws the index up, screws up everything. So then base metals, that was a big rush last year. So, and then this more recently you had a nice rally in crude oil, but the oil stocks didn't perform as well as they should. But what you had was a decade of what was happening is the fund managers were buying the oil stocks based upon that sometime there's going to be a big trouble in the Middle East, and that'll drive oil up and drive the oil stocks. So the oil stocks were performing better than crude oil for 7 or 8 years. And then all of a sudden they realized that with all the shale production coming on in the States and now being a net exporter of crude oil and other areas working on shale drilling, a lot of oil reserves being developed outside of the dreadful Middle East. So I was amazed at how long that maintained, and now it seems to be gone because the latest rally in crude outperformed the oil patch stocks, and so anyways, the crude got overbought on the latest rally. I think it got to 66.6, the devil's number, and it's correcting. We'd, as you know, had expected that base industrial commodities could be firm out to around March, and that's just plain seasonal stuff, and that's what's happened. You've had even more recently, copper has firmed up. Other base metals have, but they're beginning to correct now. Some of the exotics like cobalt, it rallied and it's going sideways for the last month. Lithium rallied and is correcting. So then crude, we got the rally there and correcting. So the fundamentals of a bull market are often firm to rising industrial commodities. Now, within this set, lumber has been absolutely fabulous, terrific rally. And this week, it became overbought, like upside exhaustion readings, which are extreme. Also, that relates to momentum, and then also there was a sequential sell in there which relates to pattern. And the last time we had these was about 2013, and it concluded a very strong rally and then a long price decline. So on these signals, sometimes the rollover in the item is not often instantaneous, but these are dispassionate measures of speculation, and so you know that somewhere we're close to a top in the lumber, and the base metals are faltering a little. Crude oil is faltering. So those underpinnings of the stock market are no longer underpinning, let's put it that way. And then you have the action in the interest rate market. And this was interesting, Jim, because on the speculation on the blockchain and Bitcoin stuff, there was a probability that could conclude in the December-January window. And then on December 19th, we got on Bitcoin itself, got the sequential sell pattern, the first time in 2 years, and we concluded, well, it's going to get the biggest correction in the couple of years, and it has indeed. It's still not enough evidence yet to conclude that was the top of a great bubble. It would take, of course, the price chart breaking down on these things. It's taken a mighty whack. Some of them fell in half. And you've had the rebound, and we're just watching to see what happens next. You have to measure the speculation, and it became exceptional. But what can happen in sectors like this, particularly advancing technology, is you look back in previous periods when, for example, in 1929, Radio Corp of America was radio and records, phonographs, all the terrific new stuff. And but the speculation got away ahead of itself. The stock crashed with the rest of the market. But the technology, the advance in radio then led to the advance in TV and that sort of stuff, continued. And then the 1873 bubble, the big high-tech stock was Western Union Telegraph. And it got hit real hard. But, advancement in telegraphy and communications and everything, it all continued. It probably got a little more difficult to finance when you've got a crashing stock. But what it does show is that the fashion of the day and the speculation attendant can get way ahead of what the company's actually doing. And so this is what could be happening with the Bitcoin phenomenon. Fabulous bubble. But speaking of bubbles, you've had in 2015, the big peak. 2016 was the big peak in long-dated treasuries in Government of Canada bonds, and in July they got up to all kinds of technical excesses, and we pointed this out and said that quite likely that was the end of a trend in falling long-dated rates that began in 1981. And then now, in the last month, you've had interest rates turning up and breaking out of the long downturn channel. So,
Bob, maybe we can explore that when we come back after the break.
Sure thing.
We'll have more with Bob Hoye right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're speaking with Bob Hoye. Bob, speaking of interest rates, as we were just before the break, the Fed has hinted they may hike rates more than 3 times this year. What's that going to do to interest rates in Canada? Do they have to follow suit?
Oh yeah, it's a world market for interest rates. And the other thing is, when you bring it up, I always come back and say, the Fed isn't causing the rise in interest rates. The rise in interest rates is part of the boom. And in a boom, whether you've got a Federal Reserve system or a Treasury system, interest rates go up in a boom and they go down in the contraction. So the Fed is just trying to look like it's in charge, because you've got a contrast here going on now whereby the orthodox side of the street has to voice that they're very concerned about rising interest rates. And to that one I say, hey, so long as the boom is on, interest rates will be going up, and rising interest rates then become an indicator that the boom is on. What you want to worry about is when they go down. And then the Fed then has, in order to look in charge of things, they got to raise rates. So the orthodox world is fearful of rising interest rates, but then the head of orthodoxy, the Fed, has to raise rates because interest rates are going up, so they then have to look in charge of it. It's complete nonsense. And the long rates are going up. Short rates, like the 3-month T-bill and 3-month LIBOR in London, they're going up faster recently than the equivalent period in 2007. So, rates are really going up. And that the Fed says they're going to do 4 more interest rate increases. The Fed doesn't know, because at some point, who knows when, but maybe after mid-year, if the T-bill rate starts coming down, it's saying that the party's over. And then that would then be followed by 3 or 4 months with then the Fed suddenly discovering, oh, we'll lower rates. So, honestly, the hypocrisy of central banking is amazing. And what is also amazing is that so many people follow it without a critical eye. And but as I say, and here's the other irony, in 2007, when the credit markets were becoming strained because of the speculation, and people worried about, rising rates, then the big wigs were saying, no need to worry, because the Fed will lower interest rates and that'll keep the party going. And yet you've got few hundred years of evidence that in the senior economy and with the senior currency, the pattern is that short-dated interest rates like T-bills go up in a boom and down in a contraction. And indeed, they fall the fastest. And if you just take, 300 years now, going back to 1720, the instruction is that in a bear market after a bubble, interest rates decline real fast. And yet you had the guys in 2007 saying, oh, declining interest rates will keep the party going. So I think you'll see this yet. When the stock markets and credit markets become a little more nervous, then the establishment gets out its cheerleaders and say, oh, well, everything will be fine because the Fed can cut rates. You'll find that on the next contraction, the stock market will be going down, and at the same time, the Fed will be cutting rates very quickly, and it doesn't work. So it's an amazing sort of confection that they've created, that what the Fed does, the market follows with, and it just isn't true. You've got the first central bank of issue and influence was the Bank of England, and it was chartered in 1694, and the first big bubble was 1720, and you've had big, huge financial bubbles about twice every 100 years ever since. And you had 1929 was the fifth bubble. 2007 was a great bubble, but I think this one is even greater. It could be a very important bubble, and we'll just watch and see how it goes.
We'll have more with Bob Hoye right after the break.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the Royal Bank of Canada posted a $3 billion profit in the first quarter. They seem to feel that, I guess, financials are still a good place to be. Oh, yeah. You're in a financial mania. The whole world is actually doing financial business, and the Canadian banking system underlying it is pretty good, pretty sound system, and they've extended into the U.S. and elsewhere. So they become rather big banks, but also part of the announcement this morning on the Royal Bank was that they will be buying their stock out of the markets. And I got a chart here now. It's the S&P on price to sales ratio, and it's as high as it was in early 2000. There's another reliable measure of valuation, which is you take the average wage in the United States and divide it into the S&P. So you end up with a chart on the number of hours one has to work in order to buy a unit of S&P. And it is, a number of points higher than reached in 2000 in the dot-com bubble mania thing. So valuations are high, and the way that the street rationalizes high valuations when institutions want to buy stocks is that the stock analysts come out with tremendous projections of growing earnings that make the PE multiple look less. But if you take it against, I think the one I like is against wages, and wages don't change all that fast. So at any rate, the Royal Bank of Canada is on a program to buy its stock out of the market, and this market is highly speculative. Now, typically, with corporations on the Treasury Department, which looks after the financial side of a company,
is that they typically look at interest rates, and because they will want to do their lending, they want to borrow money at the lowest interest rate. So you'll have a company with, more or less with a prospectus all set to go, and then when the treasurer and acting with the underwriter determine that, hey, interest rates are low, let's get this bond issue out. That's nice timing. As a market person, you got to admire it. But at this point, for a company like the Royal Bank of Canada to be buying back its stock out of the market is really not sound banking at all. It is reckless, and I don't think it can be rewarded for too long. So, but it's an example of groupthink and doing the wrong thing.
Bob, thank you so much for chatting with us.
Well, there we go. We've done this week's chat, and we'll look forward to next week's.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HoweStreet.com radio. Find us on Twitter at HoweStreet. You can forward questions to Bob or any of our other guests at info@HoweStreet.com. A reminder, our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.